Welcome to Talk Tickers, where we break down the latest earnings calls for investors. Today, we're diving into Equitable Holdings, ticker EQH, because their latest quarter was a fascinating case study and a company telling one story and the market hearing something completely different.
So check this out. On November 5th, after Equitable's management laid out this really confident long-term plan, what did the market do? It sent the stock plummeting almost 7.5% on some pretty heavy volume. Let's break down exactly why that happened.
This quarter's story is all about that massive gap between management's narrative and the market's immediate and frankly pretty harsh judgment. It's like they were speaking two different languages.
And this slide really says it all. On one hand, you have the market's view, which zeroed in on the negatives that spooked investors, missing on earnings, missing on revenue, and a pretty ugly GAAP net loss. But on the other hand, you have management trying to focus everyone's attention over here on the record assets under management, strong net inflows, and a really powerful capital return program.
And when you dig into the numbers the market was focused on, you can see why they were concerned. These were clear misses on both the top and bottom lines. Even after you adjust for all the one-time stuff, their operating EPS still missed by almost 7%. And yeah, that big GAAP loss was due to a specific deal, but let's be honest, a headline number like that is always going to be a tough look.
And yet, despite all those misses, management's tone was entirely forward-looking. The CEO, Mark Pearson, kept emphasizing their confidence in this long-term strategy that they've built around what they call the flywheel model.
And this confidence wasn't just talk. They backed it up with tangible action. They deployed a massive $1.5 billion in capital just in the quarter. And you can see here, more than half of that went directly to shareholders through buybacks, with the rest going to pay down debt and fund strategic moves like their big acquisition of Stifel Independent Advisors. So at the end of the day, this is the crucial point. Investors were left trying to decide which story mattered more: the messy quarterly print that just came out, or the optimistic, long-term strategic vision that management is trying to sell.
So what is this flywheel they keep talking about? Well, the idea is that their integrated model creates this self-reinforcing cycle of growth. Their different business lines all feed into each other, and with record assets and strategic acquisitions like Stifel, they believe they can really bolster their future earnings power.
The market, however, remains pretty skeptical for now. You can just look at the stock's performance. It's significantly underperformed not just the broader market, but its own sector over the past year. Closing that gap is what this is all about. Now, during the Q&A session on the call, analysts really started to poke holes and ask the tough questions. They mostly focused on two key areas of concern to try and understand the risks hiding underneath all that optimistic guidance. First up was private credit. This has become a real hot-button issue for a lot of financial companies, and for good reason. So analysts were asking, how real is this risk on your books? How good is the quality of your exposure?
Management's defense here was really centered on their deep internal expertise. They argued they do their own homework, they have a conservative approach, and they believe they're being properly compensated for the risks they're taking. They made it clear they're avoiding the exuberance and weak deals they see elsewhere.
All right, the second big question was about competition. Specifically, in the RILA space, that's the registered index-linked annuity market. Equitable was a pioneer here, but now it's an incredibly crowded field. So can they maintain their edge?
And what was their answer? Well, they pointed right back to that flywheel. They argued that their integrated distribution and asset management arms give them a sustainable competitive advantage that other companies just don't have. So, after weighing the messy numbers against what is actually a compelling narrative, here is our take on what comes next.
We are initiating with a market perform rating. The thing is, the long-term story is credible, but we think the stock is likely to be range-bound until management can prove they can align that narrative with some clean, consistent execution. It's a show-me story now.
Now, for traders with a higher risk tolerance, the plausible trade here is to bet on that narrative shift. The thesis is basically that the big drop was an overreaction, creating an opportunity. You'd be looking for specific catalysts, like a smooth Stifel integration and continued buybacks, that would signal the market is starting to believe that long-term story again.
And as always, this is not financial advice.